you may owe use tax. It's easy to figure out how little you may owe. For most purchases, you don't even have to save your receipts. Just use this convenient use tax table available in your income tax instructions. Find your adjusted gross income to see how much you may owe and enter that amount when preparing your state income taxes. It's that simple. No looking through files and no hassles. You've paid your use tax for the whole year.
That was easy.
Paying your use tax. Good for you. Good for California.
We're committed to supporting our communities, teaming up with businesses large and small, improving our roads and schools, investing in law enforcement and our environment. Together, we're funding a better quality of life. We're the California State Board of Equalization. The BOE was created in 1879 to equalize property tax assessment practices throughout California. Our responsibility has grown quite a bit since then. Today, the BOE administers more than 30 taxes and fees that provide 1/3 of all the revenue generated in our great state. And we're efficient. More than 99% of the money you contribute supports services and programs that benefit all of us in California. When you drive down our many highways, see a police officer helping someone in need, or enjoy a walk along a pristine beach, think about what makes it possible. Whether you're a business owner, making a purchase, or just filling up your gas tank, your contributions are important to our state's economic health. And the greatest part, we're doing it together. We're ready to work with you. Take advantage of our free seminars, helpful classes, instructional videos, and mobile applications. Also, use our online services. It's easy to do business with us from anywhere, at any time. Our partnership equals success. Learn more at boe.ca.gov. Together, we're supporting our communities and funding a better quality of life.
Okay, so we have your W-2 and mortgage deduction, your receipts, charitable deductions, mileage claims. Let's see, are we missing anything else? Oh, do you owe any use tax?
What's use tax?
It's usually owed when you buy something from an out-of-state company or website that didn't charge you California sales tax. So do you think you may owe use tax?
Gosh. You know, I did a lot of online shopping this year. I think I have some receipts from a few things I bought.
Oh, that's easy to add in on your return. Let's see what you have.
The revenue collected from use tax helps pay for important California services like public safety, healthcare, and schools. Remember, when you file, pay your use tax. To learn more, visit boe.ca.gov. Paying your use tax. Good for you. Good for California.
The Taxpayers' Rights Advocate of the State Board of Equalization wants you to know you have rights. As a California taxpayer, your rights are protected during the assessment and collection of taxes, including the right to courteous and prompt service and the right to be treated fairly during all dealings with Board of Equalization employees and officers of the Board. Publication 70, Understanding Your Rights as a California Taxpayer, and Publication 145, California Taxpayer Advocates, can be useful helpful in learning about your rights. If you feel the BOE has not resolved your concerns adequately, please contact the Taxpayers' Rights Advocates Office at 1-888-324-2798 or email us. The Taxpayers' Rights Advocate of the State Board of Equalization. We're here for you.
It's easy to buy things online these days, but did you know you may need to pay tax on those items?
Really?
It's called use tax. And just like sales tax, the use tax you pay to California will help fund important services like public safety, healthcare, and schools. But how do you know if you owe use tax? When you buy things online, look to see if you were charged tax when you checked out. If you weren't, you may owe use tax. It's easy to figure out how little you may owe. For most purchases, you don't even have to save your receipts. Just use this convenient use tax table, available in your income tax instructions. Find your adjusted gross income to see how much you may owe, and enter that amount when preparing your state income taxes. It's that simple. No looking through files and no hassles. You've paid your use tax for the whole year.
That was easy.
Paying your use tax. Good for you. Good for California.
We're committed to supporting our communities, teaming up with businesses large and small, improving our roads and schools, investing in law enforcement and our environment. Together, we're funding a better quality of life. We're the California State Board of Equalization. The BOE was created in 1879 to equalize property tax assessment practices throughout California. Our responsibility has grown quite a bit since then. Today, the BOE administers more than 30 taxes and fees that provide 1/3 of all the revenue generated in our great state. And we're efficient. More than 99% of the money you contribute supports services and programs that benefit all of us in California. When you drive down our many highways, see a police officer helping someone in need, or enjoy a walk along a pristine beach, think about what makes it possible. Whether you're a business owner, making a purchase, or just filling up your gas tank, your contributions are important to our state's economic health. And the greatest part, we're doing it together. We're ready to work with you. Take advantage of our free seminars, helpful classes, instructional videos, and mobile applications. Also, use our online services. It's easy to do business with us from anywhere, at any time. Our partnership equals success. Learn more at boe.ca.gov. Together, we're supporting our communities and funding a better quality of life.
Okay, good afternoon, members and guests. Welcome to the State Board of Equalization. Ms. Richmond, please call the roll.
Chairwoman Ma,
Here.
Ms. Harkey,
Here.
Mr. Horton,
Here.
Mr. Renner,
Here.
Ms. Dowers.
Here.
There is a quorum, therefore the board is called to order. We will commence with the Pledge of Allegiance led by Mr. John Walker. Mr. Walker served 9 years of active duty with the Air Force, 6 years with the California National Guard, and 11 years of civil service with the Air Force. He has been with the BOE for 1 year and currently works in the Technology Services Division. Welcome.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you, Mr. Walker. Okay, Ms. Richmond, please call the first item.
Good afternoon, Chairwoman Ma and board members. Our first item on today's agenda is item B, corporate franchise and personal income tax appeals hearings. Item B2, Gino Ma and Marian, Chou, please come forward. Board proceedings has received contribution disclosure forms for today's hearings from the parties, participants, and agents. All forms were properly completed and signed, and no disqualifying contributions were disclosed. All parties, participants, and agents are on the alpha listings provided to your office. Each person sitting at the table will be asked to introduce themselves and, if necessary, their affiliation with the taxpayer for the record. 10 minutes is allocated for the taxpayer's opening presentation, followed by 10 minutes for the franchise tax board's or department's presentation, and 5 minutes is allocated to the taxpayer for rebuttal. Chairwoman Ma.
Thank you, Ms. Richmond. Mr. Appellate, please introduce the issues in this case.
Good afternoon, Chairwoman Ma, members. Anthony Uplight and Lou Ambrose of the Appeals Division. There's one issue before the board in this appeal, whether appellant's claim for refund are barred by the statute of limitation pursuant to Revenue and Taxation Code, Section 19306.
Okay, welcome to the Board of Equalization. You will have 10 minutes to make your initial presentation and an additional 5 minutes on rebuttal. Please introduce yourself for the record, and you may begin.
Hi, my name is Gino Ma.
Okay, please begin.
And I can continue?
Yes, please.
Okay.
10 minutes.
Okay. I never had any problem with tax payments, delinquencies, or just underpayments until around 2007-8, where my family had a sickness in the family. My father-in-law became disabled, and eventually he passed away. It's just a spiraling set of health issues, such that it forced us to move over to their residence initially, and then eventually he had to be sent to a nursing home. And during that time, I was split between, my household was split between our home, and the condo. And while we were previously about to start a renovation, so some of the stuff was moved into storage. And it was increasingly impossible for me to gather all of my records to properly in one place in one time to finish my tax filing. So starting from my 2007 tax year, I just wrote a large payment to make sure that I don't become a liability tax-wise or financially to the state. But I wasn't able to file my taxes for a while until my father-in-law passed away. And then, but during that time, I was traveling almost completely 40-some number of weeks out of a year, mostly from a few days up to a week at a time. And my wife had to spend her time between the in-laws' home and the school where my son was going to preschool. He was about 3, 4, 5-ish during that time. And then later on, the nursing home as well during the day. So it was impossible for us to attend to our own home, which during that time had been burglarized once. And mail delivery, we weren't able to go by there and to pick up anything and often. And the delivery was not reliable. We had sent for mail forwarding, and a lot of the mail wasn't delivered to our new address. And the mail was also often left at the flap where it could be taken by passerbys. But during that time, I later on, when my father-in-law passed away in 2011, I filed all of my taxes, which showed that I had an overpayment of over $5,000 in each one of those years that are in contest. And I filed them, and I moved the excess payments to my subsequent years. And during that time, I have not received anything since I went back home after 2011. Received any notice from the FTB that any of those tax returns were incorrect, that they disagree with it. Okay, and in fact, the first time I hear any deviation from my filing was in my 2013 filing, which they told me was insufficient, which surprised me because I thought I had a large $5,000 of transfer from my 2012, and then I found out I didn't have that much money, and then I went all the way back to 2007 and found out that they had assessed penalty and interest, demand penalty and interest on those accounts, which were not made known to me after I had filed my tax return. And so for about 6 years in a row, my 6 years of tax returns, no questions were ever raised on those tax returns after I had filed them until 2013. And by the time I received this notice that the 2013, what I had underpayment, it was already too late for me to go back to pursue my 2007 demand penalties that had accumulated over the years such that I was incurring a deficient fund for 2013. What I'm been told is from the FTB is that they've been sending me proposed assessments during the time between 2008 and 2010. But during that time, as I mentioned, my mail delivery was very spotty, and I had received 2 register mail notices. They weren't clearly labeled, so I couldn't see who they were from. When I went to the post office, I found out that they were already returned. So I never really found out who sent them. And I was told that they were all sent to my address, and that's legally sufficient for their notification process. But my contention is that after I had filed my 6 or 7 years of return, which they had disagreement, they never really raised any issue until it was way too late after the statute of limitation had already run out for me to raise this issue. So right now, I would like to have this addressed because it's a $3,900 total payment that I was assessed as a penalty for which I never really needed to pay because my accounts were never delinquent or, never insufficient. I had kept a balance, a substantial balance of over $5,000 in each of those years. Okay, so that's what I'm here for.
Okay, thank you. So we're going to have the Franchise Tax Board give its presentation for maximum 10 minutes, and then we can go back to you, Mr. Ma, for your 5-minute rebuttal.
Thank you. Good afternoon, Chairwoman Ma and members of the board. My name is Andrew O'Mara. I'm with Marguerite Monnier, and together we represent the Franchise Tax Board in this appeal. As your board's aware, this is a statute of limitations case. The primary issue is whether appellants have established that they've filed their refund claims within the applicable statute of limitations periods. For background, appellants failed to timely file tax returns for the 2007 through 2009 taxable years. FTB issued demand for tax return notices to appellants, and appellants failed to timely respond to those notices. Appellants eventually filed their returns for those years in 2011, and then more than 4 years later, in July of 2015, they made refund claims for those years. FTB denied the claims for refunds based on the expiration of the applicable statute of limitations periods, and appellants timely appealed the denials. Now, statute of limitations periods are mandatory, and they may not be waived for reasonable cause or ignorance of the law. Refund claims plainly must be filed within 4 years of the due date of the tax returns or 1 year from the date of overpayments. Appellants have unfortunately neither demonstrated or even asserted that they made timely refund claims in this case. Accordingly, as stated in your board's hearing summary, because appellants did not submit refund claims in a timely manner, the statute of limitations serves as a bar to the claims. I'd be glad to take any questions your board may have.
Okay. Okay, Mr. Ma, 5 minutes on rebuttal.
Okay. Firstly, the notification, I'm fully aware of the statute of limitations, but it's impossible for me to even be aware there was a discrepancy between my filing. When I file a tax a return, if I don't see any responses, I assume that it was accepted because there's no other way for me. It's a negative confirmation. So if I don't hear anything, I assume everything's filed correctly. And if that happens for years until the statute of limitation has run out, I feel that it's not the statute of limitation that I'm contesting, but rather the fact that I was not made aware that there was an issue in a way that I could have responded. So logically, there was no way for me to do any better. And I've been in good faith trying to prepay my years when I couldn't have filed my taxes in time, so that I was never in delinquency in underpaying or become a liability to the state financially. So that's, I'm doing the best that I can possibly do under the circumstance, given that I was not notified that there was a demand payment. And in fact, the proposed amount that they sent, which I never received that notice, it's not for the same amount that eventually that they assessed me. So there was no time during that time that I even was aware how much was assessed. Finally, there was no resolution on it until 2014 when I inquired into this, and that's when the amounts were made known to me that they have been assessed and what the actual amounts were. Of course, by then, it was already too late for me to take an action within the stated law. So it wasn't my intention or ignorance of the fact that there was a statute of limitation.
Okay, questions? Ms. Harkey.
Hi. I heard, this would be for the department. From 2007 to 2009, he didn't file tax returns, but he paid. Mm-hmm. He paid overages, and then he filed those in 2011.
Right.
Did he file 2011, 2012, 2013, 2014 on time?
Yes.
I don't have that information in front of me, but if that's the appellant's assertion, I don't have any reason to doubt that.
Okay.
And I was not notified that there were any discrepancies because each year I had claimed that there were over $5,000 that were transferred from the previous year. So this figure should have been disagreed with by the FTB for all the 6 years that had transpired. Right. Until the first time I heard any notice was in 2013 tax return that it was short of funds.
Okay, for the department, I know you said you mailed a lot of about 12 or so notices, separate notices and statements. When he sent in his payments in 2011 and the tax return in 2011 and 2012, Had you notified him that he had an issue, or was the first notification that he's filing was insufficient actually 2013?
Are these to our opening brief?
I'm sorry, yeah.
Exhibits V, W, and X to the opening brief are printouts of what we call our tax year history of activity display. And they all indicate, they all have line item statements showing that when we processed the returns in 2011, when he and his wife filed them, we sent them what we call return information notices that would advise him of those penalties and how we had applied the payments to satisfy them.
I have only seen notices in those exhibits that predate my filing of the previous return years. Okay, so I have not received, and I have been back in my residence since then. I cleared up all the problems, and so I was able to return to my home. So I can say that there were no returned or unseen mail since then.
When did you return to your home?
2011. That's when I was able to go return after the death in the family, and I was able to go back and file my tax returns and clear up all the backlogs.
Yeah.
And there have been no notice sent to my home in regard to any of those tax years or the ones afterwards.
Until 2013?
Until 2013. And I thought I reviewed those exhibits, and I noticed the same. In fact, I brought that up with my attorney. There were no notices. All the notices were sent prior to my completing of my tax return, and they would have been proposed assessments, because I've seen some exhibits being shown.
Okay, thank you.
Okay, Ms. Stars.
Thank you. To the appellant, I want to make sure I understand what you're saying, that when the tax returns were due, in the 2007, 2008, 2009 returns, you were unable to timely file your tax return due to the illness of your father-in-law.
And the fact that our household was moved to two separate places, and I couldn't get all of my tax records together. I didn't want to file a partial return and then correct it later on. I just wanted to wait until I can collect everything so I can file it properly.
Okay, I understand that. But you continued to have, so you basically maintained two households, one where the address that was used when you actually did file your tax return, and the address, which I'm assuming was your
in-laws.
Your in-laws' place. Okay. Did you ever notify the Franchise Tax Board of a different mailing address?
No, because I haven't been filing my taxes, and I haven't been communicating with the FTB during that time. I was way too busy.
Okay.
As I said, I made a large payment to ensure that I wasn't going to be financially at a liability.
Okay,
right?
I understand that. Were you able to work during that time period?
Was I able to work?
Yes.
I was working continuously. I was traveling extensively.
Okay, good, thank you. To the Franchise Tax Board. Will you please provide me with a timeline of events, starting with when you first had information indicating that there was a filing requirement and the demand for the tax returns were sent to the last known address? Will you please discuss why a demand penalty was imposed under the statute and the requirements under your regulation? Also discuss when you mailed the return information notices regarding how the monies were moved back and forward. One more thing, and also I'm not sure if I said that, also discuss the rules with respect to last known addresses.
Sure. The 2007 tax year demand notice went out March 9th, 2009. The 2008 demand notice was mailed out February 10th, 2010. And the 2009 demand notice was mailed out December 28th, 2010. The purpose of the demand notices are to produce their demand for tax return notices, and the purpose is to produce filing compliance from the taxpayer, which resulted here. The prerequisites for the demand for tax return notices and then the penalty for failure to comply is that there must have been a either request or demand for tax return notice issued within the prior 4 years, followed by a failure to comply and notice of proposed assessment. That statutory prerequisite was met here because there was a 2006 request for tax return notice that appellants failed to comply with, and it resulted in a notice of proposed assessment for 2006. I'm sorry, I missed the last known address. Legally, FTB is required to mail notices to the last known address that it has, and that is generally pulled from prior tax returns. FTB is not required to, the taxpayer is not required to actually receive the notice under the law. FTB is only required to mail the notice to the last known address. It's not required to confirm receipt, and that occurred here as well.
And what about the return information notices?
Oh, I'm sorry. For 2007, there was a statement of tax due notice that was issued in November of 2011 to the address that appellant indicated on its tax return, and that notice would indicate how payments were applied, among other things. For 2008, there was a statement of tax due notice and a return information notice issued in October of 2011, again after appellant's 2008 tax return was filed, and to the same address. For 2009, there was a return information notice issued in June of 2011, again indicating how the payments were applied, and again after the tax return for that year was filed to the same address.
Okay.
I did not, can you cite the exhibits? I did not notice anything that was sent after
Exhibit V
October.
to the FTB's opening brief. Line 17, page 2, line 17. Exhibit W to FTB's opening brief. Line 5 and 6, and then the return information notice is line 16.
That's a $100 amount?
And then for 2009, Exhibit X, line 5.
Okay. Thank you, Franchise Tax Board. It seems to me that, excuse me, sir. It seems to me that the Franchise Tax Board did attempt to communicate with you to your last known address with respect to demanding the tax returns. And then once the returns were filed and adjustments were made to your account, they again mailed to your last known address statement of tax due and return information notices indicating that what you thought was an overpayment being applied to 1 year was actually being used to cover the demand penalty. I understand your position that you did not receive those notices. However, under the law, FTB is only required to send to the last known address. Whether you received them or not, it's really out of their control.
Okay, I just want to note that that was for, it was written activity amount as being $100. Is that the amount that's being addressed? Because that doesn't match any of the amounts we're talking about here.
Okay.
Which, I'm not sure which year or
The line number 17 that you cited.
Oh.
I have not received, I honestly have not received anything since I filed my tax return.
Chairwoman Ma.
Mr. Appellate.
Might I request that appellant address the board only?
Sorry, Mr. Ma, if you can address.
Okay, so the line numbers were not for any of the amounts that even close to, and I certainly haven't seen any of the actual communications sent on those dates. And I don't believe that I've seen any, and they don't match the amounts that were discussing here. I mean, these are not, I certainly haven't seen them.
Okay, so the Franchise Tax Board has said that they issued you 6 different notices on 6 different dates. So, Mr. Appellate, what is the law in terms of notices, burden of proof, receipt of mailing? I'm not sure, but I'm sure you have an answer for us.
Well, as Ms. Stowers has mentioned, as the Franchise Tax Board has mentioned, the Franchise Tax Board's obligation under the law is the mailing of notices to the taxpayer's last known address on record, which there does not appear to be any dispute that that's what the Franchise Tax Board did here. There's no evidence in the record that there was any return of these notices to the Franchise Tax Board, so it appears that the Franchise Tax Board completed its obligation here of notifying the taxpayer of these notices here.
So, Mr. Ma, how many of those 6 notices did you receive?
I have another question. These activities, I was noticing that previously there are some places where it says notice. Okay, this one, it just says SCR delinquent for $100, and there were no notices, which is the reason why I hadn't noticed them before, because I was looking for where notice was sent. And the account activity list does not state those were notices. They were just saying they assessed the delinquency.
Okay, but,
right?
you know,
I haven't seen the notice, and I don't see any annotation here that notices were sent, even, much less received.
So you're claiming you did not receive any of those notices?
And I'm looking at these activity, and I don't understand the full, they're in shorthand notation, abbreviated notations, and they don't show as notice, whereas previously I can see there were something else that's say October 26, 2011, where it says notice. Okay, so if you look at the activities list, the ones that were cited, they just simply say some amounts were assessed, but they weren't notified. There were no notices.
Okay.
Which is
Mr. Appellate.
I would also note that all of the records and notices that we're discussing currently are part of the appeal record that the Franchise Tax Board would have included as part of its evidence in this appeal that would have been available to the taxpayer prior to today's hearing, that he would have had available to review prior to coming before the board today.
Which I did.
Okay. So that he hopefully should have reviewed before coming before you.
Okay.
Which I did review, which was the reason why I stated I haven't seen any notice being sent explicitly, in the annotations of activities after my tax was filed in September of 2011.
2011.
Okay, so if you look at those events, activities, there were no notices. I understand they were assessed, but I'm saying they were assessed without my notice for 6 or 7 tax filings. And I was never notified, and certainly was never notified of 2012, 2011 filing and all those tax years.
I think this case has to do with the statute of limitation issue, and not necessarily whether the Franchise Tax Board sent the letters, whether you received the letters. So the statute of limitations, I think, is fairly clear in its 3 requirements. And Mr. Appellate, maybe you can read us what the statute of limitations are for filing a refund claim.
Well,
4 years.
Essentially, we're looking at 4 years from the filing of the return, 1 year from the date of the last payment, or 4 years from the due date of the return without regard to extensions. And essentially here, we're looking at 4 years from the due date of the returns for the 2007, 8, and 2009 returns. The claims for refund for the 3 years were filed on July 6, 2015. And essentially, unless appellants were financially disabled during the time that the 4 years were running, to have told the statute of limitations within each of those 4 year periods, the statute of limitations being strict liability statutes to somehow toll the statutes within those time periods. The statute of limitations have run
Okay.
here.
So that was the only exception?
Yes.
Okay.
Ms.
Harkey.
Hi, I would like to say to the taxpayer, this is a really sad case, from my opinion, because you did prepay, you just didn't file the forms. Unfortunately, we are guided by law as well, and the statute of limitations is very important statute. We try not to break through it on either end, either the taxpayers and you will hear us up here sometimes rooting for the taxpayer on the statute of limitations, and other times we need to support the department. It is a hard and fast rule, I think you've heard. It makes me really sad that this has happened to you, and I want to apologize, but I can't support it based on the statute. It's a legal requirement, it's pretty hard and firm, and I don't really see how we can get around it. And so I apologize, very sorry, and just extremely, you're a good taxpayer, you did your job, you just didn't file the form or respond, and I know it's just hard. And then we get into the statute issue. By the time you did file, it was July of 15, and that was well beyond the time for 2007 to 2009.
Okay.
So I apologize totally, I can't support it, and so I'd just make a motion to support the department.
Second.
Okay, so there's a motion by Ms. Harkey, seconded by Ms. Stowers. Okay, seeing no objection, the motion carries. So again, we apologize, Mr. Ma.
Okay.
Thank you for coming.
Yep.
Thank you.
Okay. Okay, Ms. Richmond, please call the next case.
Our next case is B3, Ameristar Casinos, Inc. and Subs. Please come forward.
Thank you.
Okay. Okay, seems everyone's settled. Ms. Richmond, please introduce, oh, you did call the item, so Mr. Ambrose, please introduce the issues in this case.
The sole issue in this case is whether appellant is entitled to a deduction for various wagering taxes paid to other states for the years in issue.
Okay, welcome to the Board of Equalization. You will have 10 minutes on your initial presentation, 5 minutes on appeal. Please introduce yourself for the record.
So I am Tom Bertino with KPMG, and I represent the taxpayer Ameristar Casino.
Okay.
And Scott Grierson with KPMG, represented for Ameristar.
Okay, please begin your presentation.
Good afternoon. We are here today to discern between taxes on gross receipts and a tax on gross income, because a tax on gross receipts is a deductible tax under 24345, whereas a tax on income is not. The regulations to 24345 do provide various gross receipts taxes that are deductible, such as business and privilege or license taxes. Ameristar Casinos is involved in the casino gaming business, and because of that, they are highly regulated by every single state in which they do business. These states impose a privilege tax for the right to operate a casino, and in order to fund the regulation and of the industry. The gaming tax base for this purpose is based on casino win, and win is defined as gross gaming receipts less payouts to patrons for winning. A real basic example of what this would be is if you had a bunch of people go into a room and surround this very pretty glass bowl and put all of their money into it. There's a few lucky individuals who get to go in and take some money out of that bowl. At the end of the day, the casino counts what's left, and that becomes their gross receipts for the casino gaming tax purposes. They do not get any deduction whatsoever for cost of operations, such as depreciation, wages, or other elements of a return of capital. The case law, the relevant case law in this case, have held that a tax that has a tax base that includes a return of capital is a tax on gross receipts. The California Supreme Court in Beamer held that when a taxpayer includes cost of goods sold in their tax base, then it is a gross receipt. The State Board of Equalization has also held, similarly held in two cases, the appeal of Dayton-Hudson and the appeal of Kelly Services, with Dayton-Hudson saying that when there is for the deductibility of the Michigan business tax, when there is a inclusion of that cost of goods sold in that tax base, then that tax is on gross receipts and therefore deductible. Kelly Services extended the argument to heavily extensive labor businesses and also held that when there is a inclusion of waging or compensation in the tax base, then that tax is on gross receipts. And these taxes at issue, or for the gaming privilege taxes at issue, are not unlike the City of San Francisco and Los Angeles business license taxes, which require taxpayers doing business in these jurisdictions to pay a tax on gross receipts. And the FTB has held that these taxes are deductible. And it's interesting to note that if Ameristar was also doing businesses in these jurisdictions, that they would pay a city business license tax for the privilege to conduct their operations in the city, and they would have a deductible tax on gross receipts in that basis. So it's the same argument in the gaming tax world, that this is a privilege tax, it's on gross receipts, and it should be deductible. So the taxpayer asks and respectfully requests this board to hold that these gaming privilege license tax paid are on gross receipts and deductible under 24345.
And if I could please just address the board with a couple additional comments on that point. The key, in my view, on this case deals with the board's decisions in Kelly Services and Dayton-Hudson, which Mr. Bertino already referenced. Those cases look to the Michigan tax and to determine whether or not the taxpayer is entitled to a deduction for cost of labor. The Dayton-Hudson case, the first case in the duo, it started out, it was a manufacturer. The manufacturer was the taxpayer who deducted the Michigan tax. FTB disallowed the deduction on the basis that it was that they had no that the tax base was on gross income, and the taxpayer successfully argued, and the board approved the deduction on the basis that because the Michigan tax did not allow a deduction for cost of labor. And this is the same fact pattern we have here relative to the gaming taxes, is there is not a deduction for appellant's cost of labor. The Kelly Services case then comes up, and you have specifically a taxpayer who is engaged in the business of providing services. And the FTB's position in that case was a little different, but maybe a little bit of old wine in a new bottle in terms of taking another tack. The argument by FTB there was that because they would only allow a deduction for the Michigan tax if you could prove you had and were subject to a deduction for cost of labor as a taxpayer. This board ruled in favor of the taxpayer in that case stating as follows, and I'll roughly quote it if you'll indulge me. The Michigan tax may be deducted on a California franchise tax return when the ultimate base upon which the tax is measured does not contain a return of capital in the context of a service business. We affirm Dayton-Hudson and clarify that the holding applies equally to service businesses. And the board continued, gross income for federal income tax purposes in a manufacturing, merchandising, or mining business is defined as gross receipts less cost of goods sold. Although the Michigan tax does not include a cost of goods sold for material acquisition when determining the tax base, it does include the cost of labor. So, and this is the important part. For that reason, in Dayton-Hudson, we held that the imposition of the Michigan tax against a base which includes cost of labor without exclusion of the labor cost of goods sold results in a tax which is measured by something other than gross income. And as a tax on something other than gross income, it was a tax that was deemed to be a deductible tax. So no further comments at this point. Yeah.
Thank you. The Franchise Tax Board, you have 10 minutes. Please introduce yourself for the record, and you may begin.
Good afternoon, Chairwoman Ma, members of the board. My name is Jenna Lewis. To my right is Shane Hoffling, and we represent the Franchise Tax Board in this matter. The issue here is whether appellant is entitled to deduct wagering taxes it paid to other states. Under California law, corporate taxpayers cannot deduct taxes paid to other states if they are on or measured by income. After the initial hearing in this matter, your board properly sustained the Franchise Tax Board's denial of the deduction claimed by appellant for wagering taxes paid because they are income taxes under California law. As you may recall, the parties agree that the wagering taxes paid by appellant only applied to gaming activity and were based on the amounts wagered less payouts. In other words, the tax base consists of a specified percentage of the amount gamblers bet or put into a machine, less what gamblers won or got out of a machine. In considering the deduction for taxes paid, the California Supreme Court instructs that the term income means gross income as defined under the Internal Revenue Code. The Internal Revenue Code defines gross income very broadly as all income from whatever source derived unless expressly excluded. The statute also provides a non-exhaustive list of certain items of income which fall under the definition of gross income. For example, it lists compensation for services, gross income derived from business, interest, rents, and royalties. For most of the items of income, gross income consists of total receipts. For example, all rents received are considered gross income, even if the taxpayer incurs expenses in generating the rent. However, in defining gross income from business, the regulations create a limited exception to this general rule. With respect to manufacturing, merchandising, and mining activity only, gross income means total sales less cost of goods sold. The courts and your board have explained how the definition of gross income applies in analyzing various taxes paid to other states. These decisions illustrate that with respect to a tax that applies to business activities including manufacturing, merchandising, and/or mining, the tax will only be an income tax if cost of goods sold is excluded from the tax base. However, where a tax does not apply to business activities including manufacturing, merchandising, or mining, like the wagering taxes at issue here, courts have determined that cost of goods sold is irrelevant, as it will never be in the tax base, and such a tax will be an income tax, even if it consists of total receipts. At the first hearing, questions were raised with respect to the LA City business tax and the San Francisco gross receipts tax. Since the characterization of one tax does not determine the characterization of another, your board voted to sustain the Franchise Tax Board. Nevertheless, appellant now argues that because the LA City business tax and San Francisco gross receipts tax are generally deductible, the wagering taxes here must be deductible as well. However, as noted in the hearing summary, appellant fails to acknowledge a critical distinction between the LA and San Francisco taxes and the wagering taxes. The LA and San Francisco taxes apply to business activities including manufacturing, merchandising, or mining. As previously explained, when a tax applies to business activities that include manufacturing, merchandising, or mining, the question becomes whether an element of cost of goods sold is in the tax base. In contrast, where a tax does not apply to manufacturing, merchandising, or mining, like the wagering tax is here, the tax is an income tax, even if it consists of total receipts. The same distinction applies for the Texas occupation tax analyzed in the Beamer decision and the Michigan single business tax analyzed in the Dayton-Hudson and Kelly Service appeals. In the first hearing, and here in the opening remarks, appellant placed a lot of emphasis on the Kelly Service appeal. In the appeal of Kelly Service, the taxpayer was a service business without any cost of goods sold in its own tax base. But your board determined that the tax was deductible because the analysis is whether the tax base contains an element of cost of goods sold under the law, not whether the individual taxpayer has cost of goods sold in its tax base. Since the Michigan single business tax applied to manufacturing, merchandising, and mining without a deduction for labor cost of goods sold, your board determined that an element of cost of goods sold remained in the tax base and the tax was deductible. I would just note that appellants have stated that labor costs is what the board was looking at. In the Kelly Service, they found that it was deductible because labor costs of goods sold were actually in the tax base. So it's not just all labor costs, we're looking at cost of goods sold. Unlike the Michigan single business tax, the wagering taxes at issue here do not apply to manufacturing, merchandising, or mining. Therefore, there is no cost of goods sold in the tax base, and the wagering taxes are non-deductible income taxes. Appellant also argues that the deduction should be allowed because the wagering taxes are privilege taxes. In support of its position, appellant cites the regulation on the deduction for taxes paid, which provides some examples of the types of taxes that might be deductible. The fact that privilege taxes are listed does not mean they are per se deductible. If a privilege tax is an income tax, it cannot be deducted based on the clear language of the statute. For example, in the Robinson case, it was determined that a tax on rent was not deductible because it was an income tax. Your board subsequently referred to the tax in Robinson as a privilege tax that was not deductible. While appellant has cited some cases that found privilege taxes to be deductible because they were not income taxes, appellant has not cited a case where a tax was determined to be deductible because it was a privilege tax. At the prior hearing, appellant also asserted that while the clear language of the statute disallows all taxes paid to other states that are on or measured by income, the wagering taxes at issue here should be treated differently because they were in addition to other taxes appellant paid to the other states. The statute simply does not allow for this treatment. Only the legislature can change the clear statutory language to allow an exception where more than one tax is paid to another state. To quickly summarize, the law is clear that taxes on or measured by income cannot be deducted. Based on the statutory definition of gross income and the cases interpreting that definition, the wagering taxes at issue here are non-deductible income taxes. It is undisputed that the wagering taxes only apply to gaming activity, and the tax base does not include any cost of goods sold. Since the tax base does not include any cost of goods sold, California law compels the conclusion that the wagering taxes are income taxes, which cannot be deducted. Therefore, respondent respectfully requests that you again determine its action should be sustained. I'd be happy to answer any questions.
Okay.
Thank you.
Thank you. Okay, to the appellants, 5 minutes on rebuttal.
Yes, thank you. In reply to the FTB's position, couple of points that are critical to the analysis and hopefully useful in your making a decision. FTB has characterized your board as having concluded that when a tax applies only to a business activity that does not have a cost of goods associated with it, cost of goods can never be in the tax base, which means that the tax must always be on income, even where the tax base consists of total receipts, and is attempting essentially to cast a rule that I think is a misinterpretation first of the Kelly decision, as well as a rule that would essentially swallow the deduction for a massive portion of the service economy. In fact, the cases and the courts relied upon in FTB's briefs include MCA and Robinson. The MCA case was a case that involved services. It was a tax on film royalties where there was no cost of labor involved, which is distinguishable from the board's decision in Kelly Services where cost of labor was involved. Second, the second case, Robinson dealt with the Hawaii excise tax on services and concluded that, the board concluded that the tax regime itself had different standards that were applied depending on the activity undertaken by the taxpayer. For manufacturers, they were taxed on gross proceeds from sales, whereas service providers were taxed specifically on gross income. So clearly a different standard for manufacturers who were taxed on gross receipts, whereas service providers were taxed on gross income, and therefore were not permitted a deduction in that case. Dayton, Hudson, and Kelly Services are the appropriate standards to apply and are the cases that taxpayers have been relying on ever since those decisions. The board in those cases appropriately defined the deductibility of a tax based on a tax imposed on services going beyond the specific circumstances that existed in Beamer. And FTB's arguments draw largely from a recitation of Internal Revenue Code Section 61 definitions of income and the limitation there on a deduction for cost of goods sold, which only applies to manufacturing, merchandising, and mining activities. In the context of services, again, as I read into the record, the board's decision in Kelly Services concluded that because there was no cost of service or cost of labor deduction in the Michigan tax, it was therefore a deductible tax. In our view, adopting the FTB's restrictive interpretation denies deductions for business license and privilege taxes that would be paid by businesses ranging from dry cleaners and barbers all the way to data center services or cloud computing. These are important issues to broad swaths of a largely service economy. And there's certainly authority on Dayton, Hudson, and Kelly Services for this board to rule in favor of deduction in this case. In terms of the FTB regulation, I think it is important to note that the taxpayer does not believe that if you have a tax that's enumerated in the regulation that it is per se deductible. But we've got to read that regulation as having some meaning in terms of what it's trying to accomplish. And if you look at the regulation, it was initially promulgated in 1965 and amended in the 80s. And it essentially calls out general taxes and licenses that are imposed on businesses. And these are license taxes, city license fees, alcohol, beverage taxes, and business privilege taxes that taxpayers generally pay on a gross basis. And I think if we read that regulation in that context, and there is a special deference or an interpretation of a business privilege tax where you look at that carefully and say, okay, is this a tax on gross receipts or is it in fact a tax on income? And applying that test the way the respondent is suggesting is saying that every taxpayer who reads that regulation and says, I have a business privilege tax, I pay it on my gross gaming receipts, therefore I think I should be able to deduct it. What respondent's argument is outside of the corners of that regulation is you'd have to dig down the nuances of, okay, now I have to step back and look at the taxing regime I'm in, and if there are no manufacturers, merchandisers, or miners that are subject to that taxing scheme, I won't get a deduction for this tax. And if that's the case, we would suggest that would be something that would be clear from the regulation and not being argued based on a strict or restrictive interpretation of the rules. Thank you.
Okay. Ms. Harkey.
Thank you. This is for the appellant. You've stated that the wagering taxes are imposed on gaming receipts separately for the privilege of conducting gaming. Is that correct?
Yes.
Okay. Are those same gaming receipts taxed again as a component of income tax in those states that have income tax.
Correct, yeah, the same receipts that are included in the gaming receipts tax base are then included in gross income for purposes of the corporate income tax.
Okay, next question. Is the wagering tax computed in a way that does not allow for ordinary deductions that are characteristic in income tax? For example, electricity, staff, repairs, maintenance of casino and equipment, other overhead costs?
Correct. There's no other deductions in that base.
Thank you.
Ms. Towers?
Don't we want to go down the line?
Well, usually, but, okay.
Yeah, okay, you called me, I'll go. For the states, to the appellant, for the states that you have the gaming tax and income tax, like Missouri, does Missouri allow you to deduct the gaming tax on your corporate income tax return?
Yes.
Do you have that statute? Because when I checked, it stated on their page that taxes paid to the state are added back.
Well, in most instances, income tax paid are added back, but privilege taxes are usually not. So I would have to look at that statute that you're looking at to see.
Why are you calling it a privilege tax?
Because it's a tax paid in order to operate as a casino in all these states. And every single statute, and I think we provided it to the board, lists them as privileges or license taxes, and they will be revoked if they're not paid.
Absolutely. That was on one of my board member inquiries.
Right.
And what you provided was two sets of statutes. I have the license statutes, which definitely include, in most cases, a privilege word or phrase in there.
Yes.
But the tax at issue here, the gaming statutes, I see nowhere in there the word privilege.
So there's two operations of that statute. One is it imposes the tax on that business activity, and two, it defines the tax base later on. I think other statutes were provided that shows what that tax base is.
You're right, exactly, and trust me, there's nothing in the gaming statutes that says this tax is being imposed because it's a privilege. It's in your license statutes, and all of them, the phrase privilege is referenced, and in some states, like Colorado and Missouri, Ameristar is subject to a license fee, and it's either annual or biannually. Under California statute, a license fee would be deductible, but on the flip side, Ameristar is also subject to a gaming tax. And again, I'm not seeing anything that says this gaming tax, maybe I overlooked it, but I'm not seeing anything that this gaming tax is a privilege tax.
If I could make a quick comment, I think the fact that these taxes were privilege taxes was not in dispute in the briefing of the matters before the board. So we did not do a thorough analysis of that issue. However, the record is, I guess it's full of evidence, I think, to that effect, that the licensing and privilege taxes are tied to the overall gaming regulatory environment. And I'll point specifically to, as an example, to the reply brief in which, on rehearing, in which we provided the AICPA descriptions of the different regulatory aspects from an accounting perspective, including discussion of the gaming taxes and their purpose and how they were calculated, et cetera. So these are clearly taxes that in most cases, not all, in the states are taxes that are used to raise revenue to fund the regulatory authority that has oversight over very tightly regulated industry of gaming. So I think that's in there. If there needs to be more development, I would be surprised.
Okay, thank you. To the Franchise Tax Board, Ms. Harkey was asking the appellants regarding the tax base, and I believe it was indicated that this wagering tax base does not allow for any deductions that you would normally get for computing net income. Can you speak to that with respect to does having or not having deductions that you would normally do for net income, does that change how your reading of the law of whether or not this tax is deductible?
No, in the statute and in the California Supreme Court case of Beamer, they say that income means gross income. So we're looking at gross as opposed to net, and the expenses that were referred to would be expenses that would be incurred in going from gross income to net income.
Okay. I don't have any more questions right now.
Okay. Mr. Runner?
Yeah, to the FTB, give me some background and on the purpose of the distinction of the cost of goods sold.
I'm not sure I can give you background. We don't have a lot of legislative history, if that's what you're looking for.
What's the need for the distinction?
The need for the distinction. So we have IRC Section 61, which defines gross income.
Mhm.
That's all income from whatever source derived, unless it states otherwise. So unless we have something that says otherwise, it's total receipts. In the context of manufacturing, merchandising, and mining businesses, we have regulation that states gross income is total sales less cost of goods sold. The case law then says that only those a tax applied to only those business activities would have the potential for cost of goods sold to ever be in the tax base, which is how you get to a gross receipts tax. Here, we're only looking at a tax applied to gaming. Gaming does not have cost of goods sold. So cost of goods sold could never be in the tax base. So it's necessarily a tax.
So you would apply that evenly throughout all service industries?
Yes. I'm not sure what you're referring to. But.
Well, other industries would have typical kinds of no cost of goods sold.
If we were looking at a tax that only applies to a service industry, yes, we'd be looking at the same analysis. If we're looking at a tax like the Michigan Single Business Tax or the LA and San Francisco taxes that we've been talking about, those apply to a really wide range of business activities, which include the manufacturing, merchandising, and mining, which puts us in a different boat where we're looking at, okay, is there a deduction for cost of goods sold or not?
In the case law, is it possible that the case law just doesn't, because of the cases that were before the court, that the omission of the fact that it didn't include an industry that had no cost of goods sold was just not before it?
I don't think so. We have the Kelly Service decision, which came after the Dayton-Hudson decision, and there's a critical distinction in those cases. So both of those cases were the Michigan Single Business Tax. In Dayton-Hudson, the taxpayer was a merchandiser, so part of an industry that had cost of goods sold. Your board looked at that tax and said it doesn't allow a deduction for labor cost of goods sold. So there's cost of goods sold in the tax base, and it's a deductible tax that's not on income. Then a taxpayer came before your board under the same Michigan Single Business Tax, but that taxpayer was a service provider. But the board came to the same conclusion because the analysis is not whether the taxpayer itself has cost of goods sold. The analysis is whether the tax base under the law as a whole has the potential for cost of goods sold. So it came to the same conclusion with a service provider because they weren't looking at the individual tax base.
Let me ask you, I think you disagree with their interpretation of the Kelly?
Correct. We're struggling to find the language in Kelly that would support the fact that, or the assertion that the board ruled in favor of Kelly because they identified the Michigan tax as also applying to manufacturers. In fact, in that case, they distinguished MCA and Robinson in coming to the conclusion that because there was no cost of labor deduction, that there was a deductible tax.
Do you believe their conclusion is not supported by the record by the board?
As it's in the opinion that from my reading of it, I couldn't see any support for that fact. I also think to the point earlier of, do you think that the earlier court decisions didn't have the issue before it? My view is the answer is yes. They had cases where they were applying to two things. They were applying to a mining activity in the Beamer decision, where they applied a strict Internal Revenue Code Section 61 analysis as a tool, to understand that it was a gross receipt. And they also looked at transactions involving royalties in the MTA decision, which is a type of income like receiving dividend income where there's no cost associated with that. So there's no sort of return of capital aspect of it, similar to cost of labor. And so I think that the board then looks at that in the context of the Michigan tax and Kelly Services and Dayton Hudson and says, you know, we disagree with FDB's interpretation, which would be restrictive of a deduction in a case when we're looking to essentially apply rules that are practical and administrable and look at it in a way where taxpayers could apply it and obtain deductions when they truly are being taxed on a gross receipts basis, rather than applying on a restrictive sort of Section 61 Internal Revenue Code analysis.
Okay, can you, at FDB, can you guide us to the point to where you felt that indeed the Kelly Services decision was indeed the basis for what you would believe the board's motivation was?
Sure. So in the Kelly Service decision, the board actually said, as a service business, Kelly Service has no inventory costs, and thus the Michigan single business tax as applied to it does not contain an element of return of capital in Kelly's tax base. So the board said, we're looking at a situation different than what we did in Dayton Hudson, because this taxpayer has no return of capital. So the only way to get out of that, right, to have the tax be deductible would be to find something else. And the board went on to say that the tax law itself does have labor costs of goods sold. So we're looking at the law as a whole, the tax base as a whole, not as applied to a particular taxpayer. And that also is in the Robinson decision, where there's actually a footnote addressing the issue of the taxpayer arguing that Beamer applied the analysis as applied to a particular taxpayer, and the court actually noted, no, Beamer looked at the tax law as a whole, not as applied to the taxpayer.
Somehow I'm not convinced that you've been convinced by what she's identified.
Certainly not. In terms of the initial quote of the language of the case, it was, if I'm reading from the same spot, it was actually a quote the board took from appellate's brief in terms of what the taxpayer was arguing in the case and pointing out that it had no deduction for cost of labor. And so I don't see, and I didn't, if there was a reference to a point in the decision where there's the broader statement that because there's a cost of goods sold deduction available to some taxpayer, you know, or because it applies to some taxpayer that has a cost of goods sold deduction, I just don't see that in the decision.
Okay, thank you.
Ms. Dowers?
Franchise Tax Board, do you see that in the decision?
I was just going to note that it does say that, it says, we therefore find that the Michigan single business tax is deductible in California under 24345, regardless of the specific components of the Michigan single business tax base of the taxpayer claiming the deduction.
Ms. Harkey?
I just have is under Revenue and Taxation Code, Section 24345, subdivision B, are wagering taxes deductible privileges?
No, the wagering taxes are income taxes. So they would not be deductible under 24345.
Okay, I have here that wagering taxes are deductible under Revenue and Tax Code, Section 24345. Is that not true?
That would not be our position.
Yeah, that is our position, is that it is true.
And
because it's a tax not on or measured by income.
Not on or measured by income.
Correct.
It's not measured by gross income or net income, and required to be paid whether or not you make a profit or a loss.
Correct.
For the privilege of doing business.
In a highly regulated gaming industry.
In a highly regulated gaming industry, and you do pay income taxes regardless. I just have a real hard time with trying to figure out how we can say that this is not a deductible expense. I mean, I know we could go industry by industry by industry and find something here and something there and something somewhere else, but I do believe that this is very much what the reg's talking about, And so and the law, the cases can be interpreted to, I guess you can read it a multitude of ways, but I just have a real hard time. And I voted last time that this was in fact a deductible expense. And I mean, they're paying income taxes where income taxes are due. And so this is a cost of, this is like, cost of what they're doing. They have to pay this in order to operate in the state. It's just, to me, it's very similar to a business license, liquor license. I mean, any number of other licenses that you have to have. You can't operate without it, and it's definitely not. It's not subject to whether or not you make money. So.
So, someone mentioned liquor license. So a liquor license is based on what?
It would depend on what the statute provides. So if it were based on income, it would not be deductible. If it were not, it would be deductible. And again, we do the same analysis. We're looking at a tax that applies to business activities that include manufacturing, merchandising, or mining. We'd look at whether there's cost of goods sold in the tax base. If there is cost of goods sold in the tax base, it would be a tax that is not on income, and it would be deductible. If cost of goods sold is excluded from the tax base, it would be an income tax and would not be deductible. So it just depends on what the tax statute itself says.
So, so what you're saying is if it is not a manufacturing, mining, or merchandising operation, which this is not, then there's no cost of goods sold, and therefore the tax is based on income.
Yes, if it's a tax that applies to those business activities, yes, only.
Okay, but take out, this is not a mining, manufacturing, or merchandising, right?
Okay.
So what is your definition?
So like the wagering taxes at issue here do not apply to manufacturing, merchandising, or mining. So there
Correct.
could never be cost of goods sold in the tax base because there is no cost of goods sold associated with gaming. So it will be an income tax. We don't have to look further. There's no cost of goods sold associated with gaming, so there can't be cost of goods sold in the tax base. So it is a non-deductible income tax.
And so what would a tax on gross receipts be?
So like the taxes we've been talking about here, the Michigan single business tax, the LA taxes, San Francisco taxes that we've been talking about, those are taxes that apply to business activities that include manufacturing, merchandising, or mining, and they don't exclude all costs of goods sold. So cost of goods sold remains in the tax base, so they are a tax on gross receipts.
So anything that doesn't have a cost of goods sold component is a tax on income in your mind?
Mm-hmm.
Okay.
I just wanted a clarification on a couple of things. I'm sorry, Mr. Horton, I think you had a question, but when Ms. Ma asked you about a liquor license, and you said that if that is based on income, it would not be deductible. Are you sure about that? Because I'm looking at the statute, and unless I'm misreading the statute, it's only referring to taxes on or according to measured by income. It doesn't say taxes are licensed. Are you?
There's a distinction between fees and taxes. Is that what you're suggesting? Okay, so fees are deductible. You'd have to do another analysis to determine tax fee. I don't think we're disputing that here.
Okay. And are you saying that the wagering tax at issue here, are you now defining it as an income tax, or are you saying it's a tax measured on income?
On or measured by income.
Okay. I want to be clear because it's not a tax on, it's not an income tax. Even I see that. Okay. Okay.
Okay. Mr. Horton.
Thank you, Madam Chair. Question of appeals. Excuse me. Can you provide us with some clarification of the distinction between gross receipts, income versus profits, or gross receipts, gross income versus profits? Just definition of those? Maybe?
Well, I can do the gross income and gross receipts, as
That'll work.
defined in the code. I'm not so sure about profit.
Profit really isn't germane to this discussion as to what is, if the fee in question is measured by income.
Right.
But I think part of the challenge here is that the understanding of what income actually is. In this case, pursuant to the statute, what the intent of the legislature was when they sought to distinguish these fees. If a fee that is measured by income, are we discussing gross receipt, which is a form of income? Then you have gross income, which is a form of income, but they have two different definitions as it relates to tax law. And then net profit, which is another source, another income, but totally different from a taxation perspective.
Right. Well, I think for purposes of 24-345, because it doesn't include definitions of, the terms, you have to go to the IRC, the Internal Revenue Code. And as Franchise Tax Board Counsel pointed out, gross income is defined in IRC Section 61 to include, it's very broad definition, and it would include, the receipts that the casinos get. That would be income. Then there's this reg that carves out an exception for mining, manufacturing, and merchandising activities or companies that specifically defines gross income for those businesses as gross receipts less, return of capital, direct return of capital, cost of goods sold. And I think the way that that's been interpreted, the way I think I read the cases, the way FTB does, is that when you have a tax, a business tax, like the Michigan single business tax that applies across the board to, goods producing companies as well as service provider companies, then there's this presumption that the tax base includes an element of a cost of goods sold, because for manufacturing, mining, and merchandising, that's just what gross receipts includes. And then the way that's been interpreted is, if that tax also applies to service industries, then again, I think there's sort of this implication that even for those kind of activities, there's this what they call labor cost of goods sold, which is kind of a new term to me. I'd never heard of it before, but that's how those cases. That's what was decided. It seems to me it's sort of like this is my take. It's like a fairness thing. If you're going to give the benefit to these other industries, manufacturing, you should give it to service. The tax ought to be deductible. Regardless of the type of business activity. That's the way I read it. But in terms of, to your question, gross income versus gross receipts, I think we have to follow the definitions in the code. That's what we're left with.
Just
Thank you.
Mr. Horn?
Thank you, Madam Chair.
Okay.
Just one quick comment. Labor cost of goods sold.
Yeah.
That's part of the computation when you compute cost of goods sold.
It is. Yeah, it is. Right.
It's not like a new term of art. It's right there.
But I think the way it's been applied here or understood here is that they're calling costs of labor. I agree with you. Labor is an element of the cost of goods sold, the cost of labor. But if you're not producing goods, then that's not, it can't be an element of that. And if it's a service industry and you're not producing goods, I don't see where that comes from. I agree with you. That is part of the cost of goods sold. That's an element of it that you have to include when you're considering, for accounting purposes, I guess, right? And tax. But I don't, for a service provider company, I don't see that there's, if you don't have goods to sell, then how can there be, a labor cost?
Absolutely, absolutely.
I mean, that's
what you were saying, that
right.
A service industry won't have this cost of labor
Right.
because they don't have a cost of goods sold.
Right. I mean, they do have labor, but not to produce goods.
Right.
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 So.
I agree with you on that point. Okay, thank you.
Any other? Okay. All right, is there a motion?
I'll make a motion to support the appeal, grant the taxpayer's appeal, finding specifically that Colorado, Iowa, Mississippi, Missouri, and Nevada wagering taxes paid to those states are deductible privilege taxes because they are necessary to maintain a license and the privilege to conduct gaming operations in these states, and the taxes are computed on something other than gross income within the meaning of the law, and the case is discussable at this hearing.
Second.
Objection.
Objection.
Okay, let's take a vote. The motion by Ms. Harkey is to grant for the taxpayer, seconded by Mr. Runner. Ms. Richmond?
Chairwoman Ma?
No.
Ms. Harkey?
Aye.
Mr. Horton?
No.
Mr. Runner?
Aye.
Ms. Dowers?
No.
Motion fails.
Is there an alternative motion?
Yes, but.
Yes, but, go ahead.
but.
Ms. Dowers?
Clearly, guidance is needed in this area. And looking that the economy is shifting towards service, I would like to make a motion to sustain the franchise tax board and issue a formal.
Object.
An issue of former.
A formal opinion.
Well,
Was that too much for you guys? Okay. Okay, let me restate my motion. Motion to sustain the franchise tax board.
Object.
Second, I'm just mulling over, Madam Chair, the formal. Only because this is so fact-based driven, it becomes an inherent challenge not to hear the evidence, not to be in the position to hear the evidence and to have a formal out there may contribute to even more confusion. I mean, I think the statute itself is inherently clear. Whenever you find a situation where the legislature puts together 4 words to explain what they believe should happen, that's pretty clear. So I think the legislation speaks for itself.
So that's why I go with just sustain the franchise tax board. I appreciate your comments, but just, my motion is just to simply sustain the franchise tax board.
Second.
Okay, motion on the table by Ms. Dowers to sustain the franchise tax board, seconded by Mr. Horton. Ms. Richmond, please take the roll.
Chairwoman Ma?
Aye.
Ms. Harkey?
No.
Mr. Horton?
Aye.
Mr. Runner?
No.
Ms. Dowers?
Aye.
Motion carries.
Okay. Thank you all for coming. Next item, Ms. Richmond.
Our next item is C3, Prok Electric Company. Please come forward.
Good afternoon, honorable board members.
Okay, hold on 1 minute.
Sorry.
Waiting for everyone to get settled.
Okay.
And then we will have our appeals. Mr. Njija introduce the issues of the case.
Good afternoon, Madam Chair and members. I'm Jeff Anjija on behalf of the Appeals Division. The appeal before you presents one unresolved issue, which is whether petitioner's purchase of the vehicle is subject to use tax.
Okay, so now to the taxpayers. Please introduce yourself for the record. You will have 10 minutes. You don't have to use your 10 minutes. Then the Franchise Tax Board will give their presentation for 10 minutes. You can give your rebuttal for 5 minutes, and then the board members will have questions.
Right. My name is Elijah Prok, representative of Prok Electric Company. And so we have two issues with the determination of the BOE. The first one, the issue at hand, is the BOE intentional misinterpretation of the first functional use of the commercial vehicle used in interstate commerce by citing business taxes law guide annotations from 2015 revision, which shall not be retroactively applied to a February 2012 out-of-state purchase. And the second issue that we have, that BOE had unlawfully levied Prok Electric Company's bank accounts in a total amount close to $4,500. And there were two separate levies assessed. There's an exhibit of which amounts are where. So our contention is, provision we relied upon is the Article 11, Regulation 1620. And we look at it as a governing provision and exemptions that apply under the California use tax law as clearly defined by this article. So the first three points here. The first definition of functional use. What is it? If you look there in Article 11, Regulation 1620, paragraph B3, and it states, for purposes of this regulation, functional use means use for the purposes for which the property was designed. The big rig was designed to carry cargo, but one must not overlook the original destination of such cargo carried and delivered to, as a defining part of the first use, and all the subsequent uses throughout the 6-month test period permitted by this regulation. This definition distinguishes between the property used in intrastate commerce and the property used in interstate commerce for the purposes of use tax. The second regulation we rely upon is the paragraph B5, subdivision C1, used in interstate or foreign commerce. If the property is a vehicle, use tax will not apply if 1/2 or more of the miles traveled by the vehicle during the 6 months period immediately following its entry into the state are commercial miles traveled in interstate or foreign commerce. Such use will be accepted as proof of an intent that the property was not purchased for use in California. And that was clearly admitted by the members of BOE that there was over 98% of such use. Examples, the third provision we relied upon, the examples of interstate commerce is clearly shown there in paragraph B7. It provides examples of what constitutes interstate or foreign commerce as it applies to functionality and the design of the vehicle. In example 3, we read, a commercial vehicle that heads to another state or country or transports property to another state or country and delivers that property within the other state or country or to another state or country. The vehicle then returns to California either loaded or empty. Nowhere does it state or indicate in this example provided that the property or persons ought to be picked up outside of California first in order to be exempt from this use tax. Even with a continuous use of up to 90 days outside of California, the law still presumes the purchase to be subject to the use tax, just to show the point, but that is not my case here, as a mileage for out-of-state use is way over 50% rule. So by clear definition of the law, that is, as it is given in paragraph B3, paragraph B5, subdivision C1, paragraph B7, example 3, it constitutes the purpose for which the vehicle was designed, and as such, this evidence rebuts the general rebuttable presumption of the law, controverted by documentary evidence that the vehicle was purchased for use outside of the state, as was evidenced during the legally allowed test period, and continued to be used in such manner. Having a load hooked up in Sacramento, where the truck was stationed, and then as it crossed borders into Nevada and into Utah, having the property which was destined and delivered to Utah places its first functional use outside of California. And this We had this issue going on since 2012, so the grievances or disagreements that we have as follows. We disagree with the position that BOE had taken in a determination of use tax liability in respect to first functional use of a commercial vehicle in this regard. After the statement of proposed liability was issued on February 13th, 2013, and mind you, we had submitted the documents at the end of 2012 upon the end of that 6-month test period, and we had not heard from BOE. The first correspondence we received was that the statement of proposed liability. And I'm not sure, am I allowed to name names? Because there's just like 10, 12 different people that were on our case.
Sure.
Okay. So the gentleman there, R.C. Shaw, supervised the casino use tax section. He had issued that proposed liability. And this case was further grossly mishandled by Jeff Reese, business tax representative, who had incorrectly dated critical documentation previously submitted, thus even further complicating the issues. And you can see them in the exhibit. I'm not sure what number they are, but they're kind of clouded. And just all misrepresented dates. And again, just to, for the sake of time, I'll skip that. So this followed by Alina Desange, centralized collection section, issuing the bank levy orders. The person talked to in interim was Kathy Lapko, who promised to pass all the documentation that was submitted there to a supervisor named Kathleen. And there was a deafening silence until our bank accounts were eventually levied against, despite the facts of us asking to escalate the issue but being silently ignored. Next person to handle the case was Lena Randolph, tax auditor, petition section MIC 38. She had incorrectly misstated the facts previously handled by aforementioned BOE representatives before her, and she had misinterpreted the above functionality definition and designed the vehicle contrary to its proven intent. She did, despite the factual evidence that was submitted on numerous occasions and directly to her. And that followed by Charles E. Potter, tax counsel, notwithstanding the evidence, and after meeting with Alina Desange and him in October 2014, the facts was still incorrectly reflected in his decision and recommendation to the Board Proceedings Division. At about this time, we lost our faith in the ability of BOE to serve the public, to be as a public servant in good faith and without any malice to serve. Thanks to another representative recommendation, our scheduled board hearing back in September 2015 was deferred. Yet again, we have another person, a tax council representative, Corinne Saxton, further incorrectly portraying the facts primarily relating to contract with independent contractor agreement, and a deliberate misstating confusion of other facts as evidenced in his supplemental decision and recommendation to the Board Proceedings Division dated August 18th, 2016, as well as not only applying the 2015 Business Tax Law Guide annotations when we're fully aware that none of that should apply retroactively. This whole experience has been shown to prove the negligence by BOE representatives in handling of required documentation, proceeding to misrepresent all factual data that was submitted in a timely fashion when was due the first time. In conclusion, to recap the opening statement, we are looking to a closure of these issues as mentioned above, namely, 1. Seeking to apply the definition of the first functional use in interstate commerce as defined by the Article 11, Regulation 1620, definition of functional use, paragraph B3, as it was applicable at the time a commercial vehicle was purchased, and as it was governed by then law, not by notations dating past that date. And 2, we're seeking to have the refund of all money collected. With this, I'll yield my time.
Okay, thank you. To the department, please introduce yourself for the record and begin your 10-minute presentation.
Thank you, Madam Chair, members of the board. I'm Pamela Mash from the board's legal department, along with Lawrence Mendel and Kevin Hanks representing staff. Taxpayer isn't entitled to a claim for refund because taxpayer's purchase of the truck is subject to use tax. On February 24th, 2012, taxpayer purchased a diesel tractor truck and took delivery in Blaine, Washington. 2 days later, taxpayer had the truck driven into California without any cargo and without being dispatched to pick up a specific load. About a month later, the truck was loaded with cargo in Sacramento and driven from Sacramento to Utah. As you're aware, a vehicle purchased outside of California, which is brought into California, is regarded as having been purchased for use in California if the first functional use of the vehicle is in California. Functional use means for the purposes for which the property was designed. So in the case of a tractor truck, functional use occurs when the truck carries or hauls cargo, or when the truck is driven pursuant to dispatch orders for cargo, because the purpose of the truck is to carry cargo. So generally, if a truck is purchased outside California but is first loaded with cargo in California and then leaves the state, the first functional use occurs in California. Now, if it's dispatched from outside California to pick up a specific load here, then the first functional use of the truck occurs outside California. So in this case, the truck was brought into California without any cargo and without any instructions to pick up specific cargo at a particular location in California on a specific date and time. And the truck remained here for about a month before it was loaded and driven for the very first time from Sacramento to Utah. So that means that regardless of where the truck ended up and how it was used afterwards, it was first functionally used here, because it came here empty and without any instructions to pick up a specific load, and it left California a month later with cargo. Taxpayer has argued that the interstate commerce exemption applies in this case, but the interstate commerce exemption only applies to property purchased for use and used in interstate commerce prior to its entry into this state. So the only relevant fact here is where the first functional use actually occurred, and there's no question that this truck came here empty and then was loaded up in Sacramento and driven for the very first time with that cargo from Sacramento to Utah. So the interstate commerce exemption simply doesn't apply in this case. And for this reason, we concur with the Appeals Division's recommendation that the truck's first functional use occurred in California, and the taxpayer was liable for the use tax for the use of the truck in California. So the claim for refund should be denied. Thank you.
Okay. Mr. Prok, 5
Again,
minutes.
you had basically cited those annotations that were in 2015, and we believe in opposition, something that, like any other code regulation that comes out, shall not be retroactively used against, the previous section that something is allowed. Two, you had missed a lot of information in between from the time the delivery was taken in Blaine, Washington, and the truck brought into California. Prior to all this, there was a contract with the motor carrier, because us as a taxpayer, we're not licensed to even, even if I were to have a driver, let's say a licensed A driver with a license A, Class A, we're not allowed to operate that motor vehicle. So we were in contract with the motor carrier, who is a legal carrier, to be able to load all the to hold all the loads, and thus having come into contract with the carrier. So this is our primary contract. In that exhibit and the explanation by BOE, it goes to explain, and there was a lot of information just completely misstated. But our primary contract was with that motor carrier, and we came into agreement that, okay, Prok Electric Company will purchase this vehicle, and from there on, it had to come to California to be legally registered, to be legally on the road. It cannot be just endlessly be using the temporary permits purchased at every state and every way station. So therefore, the truck was brought into California on contract. It was properly registered, and since it was purchased out of state, and really this vehicle was brought in from Canada, that actually put the whole transaction as a gray area for DMV to handle. Therefore, it took so long to have this vehicle properly registered. And from the date of purchase, it was about a month, almost a month, since the vehicle was just sitting there idle. And again, certain information that was cited is taken from the annotations of 2015, and that is our argument also.
Okay, Ms. Harkey.
What was the law before 2015?
I'm actually not sure to what he's referring to, because the annotations that I've cited were from 2002 to 1994 1992, and then, of course, Regulation 1620 that's been around forever.
Sir, can you explain what you mean by, you keep going back to the 2015 and retroactive? What are-
The annotations that were used by BOE in determining or making their determination, the printout that I have, date on them was 2015. And one annotation is 325.40, and the other annotation is 570.40, basically stating certain information that was presented by BOE here.
Okay, so the printout at the bottom where they printed out is 2015, but these
Correct.
annotations are not from 2015. Okay, are you able to provide any documentation that the driver who drove the vehicle to California was contracted by yourself and not by GFC?
Prok Electric Company had contracted a motor carrier to handle that part of the transaction.
Do we have any documentation to that effect?
I have a clear check, a copy of that was paid to GFC. And since this was such a long time since,
Yeah.
this is all started, I could not find the written contract as far as, but you don't pay somebody a check, dated back in 2012 for something you don't agree upon.
Okay, then tell me, what do you believe was the first functional use of this truck?
Again, we're going into the definition of what the code defines the first functional use. As we have read in the regulation 1620, for purposes of this regulation, functional use means use of the purposes for which the property was designed. Nowhere does it state that a load had to be picked up in California first or not. By all means, every single article right here, there's this presumption. Whether you purchase a vehicle and operate it out of state for 12 months, still, if you bring the vehicle within 12 months, having completely been operating out of state, it is presumed, to incur the use tax.
Did you use this vehicle for something before you got to
No,
California?
it was like I said, it had to be legally
Okay, so
registered
it
to be
was
able to
legally
use it.
registered in California,
Correct.
and then it got loaded, and then it performed its first functional use, which was to transport goods.
Interstate commerce. Prior to vehicle being even purchased and considered for this Prok Electric Company, the name speaks for it, electric. It's not in the transportation business. But since this was just a decision to try something else, there was an agreement with the motor carrier ahead of time, before anything was set in stone. Okay, let's go ahead and proceed with this endeavor. There was a talk about, the motor carrier having the certain contracts with certain wholesalers, the producers in the state, where on their own behalf, I don't know what contract they have, but my contract was with this motor carrier to provide the truck, and as soon as that legally operable, it'll be basically moving loads from day one. But it did take some time to, in order to accomplish that.
But it was registered in Prok Electric,
Correct.
so it was your truck.
Okay, well, may I take it back? The motor carrier had all the decals and licenses, and I've been watching this discussion, and there were other cases, and you guys well aware that by going into extent of, having the truck registered with IRP, if you were to operate within the state, you don't need that. You just go to DMV, pay your use tax, and be done with it. Why would I bother myself as a company to go through all that extent? That just doesn't make sense. So the whole idea and the intent, as was proved and rebutted by evidentiary documents, it was for the use in interstate commerce. Interstate, not intrastate. Just reading the definition, that's what the law defines that functional use. And we have an example, I read that example.
So what you're saying is the first functional use was interstate commerce, and what this board, or what the department is saying is the first functional use is when the truck got loaded.
That's their interpretation.
Okay,
which is
so
me.
that's what we're turning on here. Appeals. First functional use, what the vehicle is purchased for, interstate commerce, or actually loading it up and taking it out the first time?
Loading it up and taking it out the first time, or being driven with a specific load to go pick up. That is interstate, well, that's the first functional use. And the key question is, where was the truck when that started? And it was in California when that started. It put a load on the truck and then started moving, and it was in this, and that was an interstate commerce load, but it commenced here. And for sales and use tax purposes, that makes it taxable in this state.
Yeah, I understand what we're turning on now. I know where you're going. You got it from GFC. GFC took possession out of state, and you bought it with the purpose of using it for interstate commerce. So you're saying that's your first functional use, was actually used as interstate commerce.
Correct.
What I think most are seeing is that the first functional use is not so esoteric. It's when did you use the vehicle for what it was intended for? It was intended for hauling. When did you first haul? And and it was done out of California, and I think that's where the problem lies.
And again, going to the definition.
I know.
In this regulation.
I understand.
I wish you could have said, and then we could just totally skip all these other sections that talk about the presumption and all these other exemptions and so forth.
Okay, but my legal people are just kind of shooting here. If Prok brought it into California to fulfill a lease,
correct,
would that qualify as a first functional lease?
If it was to fulfill a lease and it was for a specific pickup at a specific location, date and time, which wasn't the case here. There was nothing, there was a contract, but there was no lease. And even if it was a lease, there was nothing in it about go to this, go to Pam's house and pick up this load and bring it back to Utah. That's not what we have, unfortunately.
Yeah, where DOE is coming from, they also cited in that determination decision there, they're talking about the lease with Taylor Farms. I do not have a contract with Taylor Farms. I shall not be obliged to have a specific load within a week as it is stated by Taylor Farms. I have no contact with them. My contract is with that GFC motor carrier company, and this was the contract. Bring the truck, we'll load you up, and off you go. This was the fulfillment of a specific lease with GFC, not Taylor Farms, as misstated by BOE.
I know. It's yeah. GFC took possession, though, out of state, then brought it to you. And then that was the first functional lease when it was loaded up, the first functional use. And
for GFC to be able to put their decals on the truck and all the licensing as required.
Yeah,
First, it had to be registered into, and I've seen those videos, there were a lot of discussions
yeah,
about this.
I think you're using, it's just, it's the definition is simple with regard to functional use, unless there's a lot of other things going on. But this is kind of, if you're fulfilling a lease, that would be the first functional use would be to fulfill the lease. You already indicated that GFC took possession out of state, so that was the beginning of the fulfillment of the lease.
Correct.
And then you brought it into state, which your first functional use, if you had a lease, the first functional use was in California a month later after you got it all registered. It didn't come into the state to pick up and, no, I'm just sorry. I think it's really hard. I understand what you're saying.
Well, can you base that on the regulation, not just an opinion of certain
Yeah,
representatives?
I can base it on the definition of first functional use, and I don't really want to do that. I've been really trying very, very hard to get you somewhere with this. I really apologize. I do.
Yeah, real quick.
Mr. Renner.
Yeah, just real quick. GFC had they leased your truck, right?
They listed from Prok Electric Company.
Right, okay. They had no contract for a pickup at that time?
With who?
With wherever they were,
They have
whatever they were gonna
contracts
put in the
with
truck?
people I don't even know. And this is why I'm in the business of transporting goods. I'm not.
You don't know if they had a contract when they?
They have contracts with various wholesalers and producers. But I'm not aware of what specific contracts they have and with who, because this is not my business. My business is with GFC to provide this truck. So, and as was mentioned before, once this truck is legally operable, from day one, off you go, and this is what happened there. But somehow that information gets thrown in, and those facts get misstated.
Okay, thank you.
Any other questions? No? Okay. Okay, seeing no further questions, members, is there a motion on the table?
Do I have to make it? I don't want to make it.
Move to adopt staff recommendation to deny the claim.
Is there a second?
Second.
Okay. Ms. Stour moves, Mr. Horton seconds to grant for the Board of Equalization. Seeing no objections, the motion will carry. Thank you for coming.
I didn't want to make the motion. You made a good choice.
Thank you.
Okay, Ms.
How do we
Richmond?
appeal this?
Perhaps Mr. Njija can,
That was the second item wasn't answered in this hearing.
Petition for rehearing, 30-day window.
okay, Mr. Hanks will advise you. Okay, Ms. Richmond, next item, please.
Our last item for today is item C4, Public Motors Orange County LLC. This is a waived appearance.
Okay.
I don't have an intro. I would just like to add this as a Section 40 decision.
I would like to move to adopt staff recommendation, but remove the negligence penalty. It was a first audit, and he wasn't negligent in record keeping. He provided general ledgers, QuickBooks, federal income tax returns, sales checks returns, and jail jackets. And there were just some issues that he could not prove up, and I think the department is right, but I would like to remove the negligence penalty.
I would second that comment at the appropriate time, Madam Chair.
Okay. There's a motion by Ms. Harkey, seconded by Mr. Runner. Seconded by Mr. Horton. Horton to waive the negligence penalty, but otherwise to grant for the department.
Madam Chair, comment though, if I may.
Okay, Horton.
Members, my concern with this audit is that there is a potential for, in my mind, a potential for additional deductions for the taxpayer that were not taken in consideration based on our initial inquiry of the department and should have been taken in consideration. However, in the absence of the taxpayer taking affirmative action to either ask for or provide documentation to support these deductions, it becomes inherently challenging for the board to arbitrarily do this. But I do want to encourage the department to look at audits of this nature or any other nature and take the position of trying to adjust not only in a positive but also in a negative light. And the deductions that I am referring to, this is a used car dealership, as I understand it, that floor their own product. They finance their own product through their own, a separate entity, but a separate entity that's wholly owned by them, which means that there could be bad debt deductions that we have not taken in consideration. And in the used car business, repossessions is just part of your operation. It just occurs. And particularly when you finance your own vehicles, the strategy that these companies use is they charge a high interest rate with the intention of repossessing the car, if in fact they don't pay for it. It's kind of like a security. It's almost like a financial agreement, a loan, with the car being part of the equity. Extended from that is the whole, pink slip loan program that they have out there. So, it's a little concerning that the department didn't appear that the department put forth the effort to provide the taxpayer with a deduction that seems to be obvious for this particular industry. The other deduction that I thought that I saw no indication of an adjustment for was when vehicles are sold with tax-paid gasoline inside of them, they're entitled to a tax-paid resold credit of that gasoline. And that's just indicative of the industry. More indicative of a new car industry, but certainly a used car, presuming that you purchase a car, there's going to be gas in it. You're not going to have to rush to the gas station and fill it up. And most used car dealers don't have their own gas station where they can purchase the gas ex tax. So there's just two examples of deductions that should have been taken. Members, I'm almost of a mind to maybe we should put this over and have the department sort of respond to that. Unless there's some kind of, understand, Gija?
We actually ordered a re-audit with the first DNR to expressly look at bad debts. The taxpayer had claimed in excess of $95,000 worth of bad debts. The department in the re-audit expressly looked for that. There's specific documentation that we need in accordance with Regulation 1642. Related entities aren't the same person as this taxpayer, but a retailer can claim a bad debt deduction by its lender under 1642.
Right.
They need to make a timely election that has to be on file with the board. I've got to believe that since we ordered a re-audit for them to go do it, that they would have looked, and the taxpayer was given every opportunity to provide that documentation. And if there was documentation to support it, that bad debt deduction would have been allowed, so we have expressly looked at that. I believe tax-paid purchases resold for fuel wasn't addressed. I don't know how material that might be. Could be a lot, or I don't, that part hasn't been examined. I do know that we didn't ask that question, but I know expressly for bad debts we did.
Yeah, I mean, total unreported sales, according to the audit, it's $6 million. $95,000 in bad debt on a $6 million audit seems to be relatively low, given the nature of this industry. And I believe, I can't recall exactly where I got these numbers from, but there is statistical data out there that says you can almost expect to have a certain percentage of bad debts in this industry. High interest, not necessarily your most credit-worthy constituencies. You sort of have this challenge. But here again, opportunity given to provide the evidence, no response. No response here and now. You know, we can't defend something that's not defending itself. I get that. And in these types of cases where the liability is high, and the original audit had a fraud liability on it, there's probably a lot more going on, which is the other concern I have. We, the Board of Equalization, sort of experienced back in the late 90s that these types of industries were laundering money through their through their car dealership. And so when the board came in, they just simply threw up their hands because they didn't want to deal with the criminal component of their activities and paid the tax. But even in that environment, I just feel that we have a fiduciary responsibility to be reasonable in our adjustments. And had they came before us, I certainly would have argued that the industry average for bad debt deduction should have been applied, far greater than $95,000, but that's not the case.
Okay, so do we have to make a decision on the Section 40, or?
If you make a decision on this case, we will bring back a draft Section 40 decision for you once it's gone final.
Okay, so I think the motion was to just to waive the negligence penalty, but to otherwise go with the department. And it seems like it's without objection, so that will be the order. Ms. Richmond, next item?
That concludes our business for today.
Okay, closed session will be Wednesday? Is the closed session going to be Wednesday?
Tomorrow.
Tomorrow? Okay.
Yes.
Because usually we have closed session on the first day, but.
Usually we do, but
Okay.
today is a little different day.
Okay, all right. Thank you very much. Okay, so we will be, what's the term? Recess?
Recessing.
Recess until tomorrow morning at 9 a.m.
Yes.
Thank you.